Welcome to the first ever online version of the Southwest Venture Forum. Woohoo! We are so excited that you've joined us this morning. My name is Simon Mack. I am the Executive Director of the Caruth Institute for Entrepreneurship here at Southern Methodist University. Many of you have joined on with us for the first time, and so I want to take a few minutes just to introduce the Caruth Institute, and then I'm going to talk about what we're going to do today. All right. Again, this is pretty exciting for all of us, and so hang in there as we're going to deal with some of the technology challenges. All right. So the Caruth Institute for Entrepreneurship basically runs the entrepreneurship program at the Cox School of Business. We have a dual mission. One mission is to teach regular classes to undergrads and grad students. Our second mission is really a community service mission. And so as part of our community service mission, we have three major programs. One of the programs is the Southwest Venture Forum, which you're all part of today. We also have another program called the Dallas 100 Awards, which recognizes the 100 fastest growing privately held companies here in the city of Dallas. And we're taking nominations for this year's awards program. So if you are a company that has 3 years of increasing revenues, so this is pre-COVID, so that's the good news, right? So if you have 3 years of growing revenues, go to smu.edu/Dallas100 to apply. And we're going to have the award ceremony in October. So our third community service program is a starting a business certificate class. So we teach a class just for the general Dallas business community. And it starts June 2nd. And it's basically an 8-week course where we go through the basics of entrepreneurship. So it's a mile wide and an inch and a half deep, but we take you all the way from ideation to customer validation, to writing a business plan, all the way to pitching to investors. We're signing up students right now. smu.edu/SAB is our URL. So hopefully we'll see some of you guys in our summer class. That'll be online also, so we're gonna experiment with that as well. The other thing that I wanna say for today's Southwest Venture Forum is I'm delighted to welcome the Prison Entrepreneurship Program. We've got some folks online from Prison PEP right now. All proceeds from today's program will go towards the Prison Entrepreneurship Program. And so thank you for those of you who are able to sign up this morning and pay a little bit of money. Just want to let you know all proceeds will go to Prison Entrepreneurship Program. Their website is pep.org. So again, check them out. Great organization, helping some folks that are in really challenging times right now. The last thing I would do is I want to thank our SMU Cox Tech team, all right? So we've got some folks on the tech team watching us right now, helping us, making sure that everything is going on technology-wise. And so I'm delighted to welcome on board and thank them again for helping us set all this stuff up. Okay, let's go ahead and start the program. And what I'm going to do is to kick off this program, I'm going to share the handout. So all of you should have had a handout that was emailed to you with the link. So let me go ahead and share that. All right, so again, all of you should have had this attached to your email that had the link in there. This is our handout. This is us today. Southwest Venture Forum from Dallas, Texas. I know some of you are outside of the Dallas area, so I want to welcome you to Dallas, Texas. By the way, I've been promoting this webinar outside of Dallas and even around the world, so I'm hoping we even have some folks from outside of the US zooming in. This is our topic for the day. Okay, so the first thing that I want to do is I want to introduce our program committee. So the way the Southwest Venture Forum works is we have ideas for programs, and these ideas typically go to the program committee, and then the program committee discusses it, and then we pick it, and then we go for it, all right? So I want to recognize Pat Hamner from Patriot Capital, John Hosegravy from Hunton Andrews Kurth. I also want to recognize Whitney Johns Martin from TWV Capital. I want to recognize Bill Raleigh from Texas Capital Bank. And then John Terry from Churchill Terry, who's our moderator today. Hubert Zychek from Health Wildcatters, And I'm Simon Mack from the Caruth Institute for Entrepreneurship. I will also highlight to you that we finally have an official Twitter account set up for us. How about that? We've gone to the 21st century, and our Twitter handle is @forum_venture. And so if you want to post screenshots, if you want to post comments about what the panelists or the entrepreneurs say, please post it to this handle. The other thing I want to do is I want to thank our sponsors. We have 2 media sponsors today, the Dallas Business Journal, as well as North Texas NO, which is their sister publication. And North Texas NO focuses primarily on entrepreneurs and startups in the Dallas area and the North Texas area. So again, thank you for both of them for sponsoring us. All right, so from an agenda perspective, in a minute, I'm going to introduce 3 entrepreneurs to come up, and they're going to give their pitches. All right, they're going to give 5-minute pitches. And then once the 3 entrepreneurs pitch, then we'll have our discussion topic, and I would introduce John Terry to come up and introduce the panel as well. So this is basically our agenda for the day. Okay, so let me go ahead and, oh, by the way, in the handout, there are 3 executive summaries from each of the entrepreneur presenters. All right, so this is something that they sent in to us, and so you have that in front of you. So as the entrepreneur is presenting, feel free to walk through their handout. I'm going to go ahead and stop sharing, and we're going to get ready for the entrepreneurs. So here we go. Stop sharing. All right. Well, thank you again to our 3 entrepreneur presenters. By the way, if you're interested in how you can present at the Southwest Venture Forum, it's a pretty straightforward process. You basically send your 2-page executive summary to us. Go to smu.edu/SWVF. We have a committee that will review your executive summary, and we will select you from this pool of applications. And so we are still looking for entrepreneurs to present for our September presentation. And so again, if you're interested in presenting, or if you know someone who wants to present, that's how you do it. Fairly simple process. All right, so I'm now going to move us into our panel discussion for the day. I'm going to ask John Terry to come on, and then John's going to introduce the panel, and then we're going to discuss family office investment strategies. So John, go ahead.
Good morning, everyone. Thank you for making the time to join us this morning. I'm very excited about the panelists and the program. We've chatted a little bit. It's always interested in learning new things, and I think you'll find this extraordinarily valuable. One of the things that occurred to me as we started this morning was the program committee at the Southwest Venture Forum. Typically, we schedule programs 6 to 8 months out. So the reality is this program on family office investing strategies was talked about and settled on last November. Remember last November? It was a very different world that we lived in last November. So, we always try to bring interesting, relevant topics to the people who participate in the Southwest Venture Forum. We had no idea, of course, what was coming or what was going to happen. And it occurs to me that this is particularly interesting and relevant. And I'll tell you why I was thinking this morning. So venture investors may invest in different industries. However, the reality is they have a very specific model. Private equity guys, broker dealers largely deal with public equities, those kind of things. But the cool thing about family offices is they have nothing's off limits. They manage over $6 trillion now. So they have become, in the last decade, this very significant investing force. And the reason that I think this is so timely and relevant today is what we're going to get to hear from these experts, these active professionals in this industry. What do they think about investing? What's a good idea? What should you hold off on? What are they holding off on? Where do they see opportunity? That sort of thing. So let me jump right into sort of introducing the panel. We have with us this morning Andy Schwartz, who is the Chief Investment Officer for the J. Cleo Thompson family. So it's a Dallas-based family office. And in that role, Andy identifies investment opportunities, leads due diligence, negotiation, as well as performance monitoring on the deployed capital. So prior to Thompson, he was president of business development at Henry Investment Group. He is the co-founder and CEO of Schwartz and Bro, which is a privately held investment company, and currently sits on several boards. Next, we have Matt Ogle, who is the CEO of Legacy Knight, which is a multifamily office. So we tried to put together some different perspectives on family office investing. It's an independent family and partner-owned multifamily office that has comprehensive investment advice, strategic wealth planning, exclusive investment advice across individuals and families with a net worth above $25 million. So prior to Legacy Knight, Matt was president and CIO of a single family office where he served as managing partner, managing the family's $2 billion private equity business. And prior to that office, he was the managing director for Crow Holdings Capital, where he helped build out the SFO, single family office, to a multifamily office, 32 families and $6.5 billion in assets under management. And he comes from private banking. And I have to give a shout out. So Matt is a fine product of SMU's EMBA program, graduating in 2012. So go Ponies. Thank you, Matt. Finally, we have with us David Ward. And David serves as the managing director and partner of Ward Ventures and Ward Enterprises, which are the private investment firms affiliated with the Ward O'Hara family office. He's an independent director of Central Insurance Companies, sits on several investment-related boards and advisory committees, and has prior experience working for both private and public companies in securitizations, capital markets, so on and so forth. So David actually graduated from the Farmer School of Business at Miami University in Ohio. And again, shout out to David, earned his MBA at SMU. So, David is a little younger than Matt, because David was actually one of my students at SMU. So, Matt managed to skate by without having to take my class. So gentlemen, welcome. Thank you very much for making time this morning. We're delighted to have you here. So what I'd like to do to kick things off is I'd like to sort of ask each of you to take a couple of minutes and describe your family office and what your current investing strategy might be. And so I'm going to start off with Andy Schwartz. Andy?
Hey, John. Thank you for having us all on, and appreciate you and the folks at SMU, Cox School, and Southwest Venture Forum for putting on this program. If you'll allow me, I also want to comment to the three presenters, entrepreneurs, Hope, Sandy, and Tony. I thought you all did a really remarkable job given a limited period of time to present your ideas, and they're all very compelling. So our family, the Thompson family, have operated Thompson Petroleum for over 50 years. The company is a legacy upstream oil and gas operator. We have assets primarily in Texas that we operate, and we also have mineral and royalty interests in a number of other states. Our family office is relatively new. We were established in 2017, and our primary strategy was to diversify the family's concentration in energy investments. We've made a number of different allocations, a lot into funds, and we generally participate as a limited partner. So primarily passive investments, and we tend to focus on sponsors and managers that have industry specific expertise and track records.
Okay, David, how about your family office?
Yeah, good morning, John, and thanks to you and SMU and Caruth for putting this all together. It's great to see everyone's faces in this interesting time. I'm David Ward. I work for our Ward O'Hara family office. We've operated a private investment office for a long time now, but we sold our core operating business, Russell Stover Candies and Whitman's Candies, in 2015. We invest across a spectrum of asset classes with varying allocations: public equities, fixed income, credit, real estate, real assets, private equity, cryptocurrency, and venture capital. Primarily, we're long-term conservative investors. Our investment portfolio looks more like an insurance company's than it would a typical investment firm, hedge fund, or pension fund. Through this cycle, we've continued to invest in credit and industrial real estate. We have a primary focus right now on distressed credit. We've been continuing to wait for opportunities in the public markets, buying stocks opportunistically. And probably the most challenged, hardest part has been on the private investment side, working with our management teams, founders, private equity firms that we're LPs with, being resourceful and helping them solve problems.
Okay. Thank you, David. Matt, same question. You're, of course, a little different as a multifamily office. Can you elaborate a little bit on that and then talk about, what current investment strategies?
You bet. So thanks for having me, John. And it's good to see the panel here. And so we are a little bit different in the multifamily office sense. We actually raised seed funding for Legacy Knight back in the fourth quarter of last year. Raised it from 14 different families, 7 of which are single family offices. And that was really just to launch the business, which is Legacy Knight. And I think for purposes of this forum, it's probably helpful just to frame it up as to where multifamily offices fit, where wealth management fits, where single family offices fit. And this is just a broad generalization. So don't get mad when I'm painting a picture here, and we could all debate this, but and the way that we see it is wealth divided up between 3 distinct buckets. 1 to 25 is wealth management. And that's typically your 60-40 equity bond mix. Sometimes they sprinkle in some alternatives in there as well. 25 million to 500 million is really where we play. And that's the multifamily office world. 500 million and up is really where you could establish a single family office, full boat, soup to nuts service. And that's generally where the majority of the family offices play in alternatives. And what we do as a multifamily office is we enable those families at 25 to 500 to invest those families at 500 million plus. And so to frame up how we invest, we look at it from a broad lens of combining 2 distinct forces. One is the endowment model, as well as the entrepreneurial nature of single family offices. And we've deemed this model what's called an entrepreneurial endowment model. And we've actually trademarked that phrase. And what that looks like is right now we have 15 families that we work with. Average net worth is 100 million plus. Each one of these families is unique. They're all allocated differently and according to their own distinct desires. And so the way that we could frame it up best from a top level is 5 to 10% is in direct investment opportunities. Another 50 to 60% is in alternatives, and the rest is in liquids.
Okay. All right. Thank you, Matt. That's very interesting. So let me sort of tag on here. You were sort of breaking down the different levels or forms of family offices. Let's take a step back and just think about the broader concept of a family office. We know the number of offices and the assets under management has increased exponentially. It's been 10x over 10 years. So can you speak to sort of the evolution? I mean, you've been involved with family offices a long time, different family offices. And Andy, I'll come to you next because you have also. What's changed over the last few years? I mean, how did these creatures become this sort of mega force in investing?
And I love that question, John. And there's a lot of reasons behind it. One is just the culmination of wealth has been astronomical, specifically here in Dallas, Texas, which has been great to see. But a big reason also is where do you go? If you have that wealth, who out there can provide the services that you need as an uber wealthy family? And so most families of that wealth need, they need access to high quality alternatives. They need access to direct investment opportunities. Most of these families have an operating business that they're still operating in. And so how do you get strategic advice as to what that looks like with what you're currently investing in? Most family offices don't just come with cash. They come with a boatload of securities and opportunities that they've been investing in for generations. And then consolidated reporting. How do you then consolidate all those reports together? And then how do you get advice for all of that in conjunction with one another? And that's why most family offices have had to say, I need to form this myself. I need to hire from the talent of Wall Street or private equity or asset management and form that position ourselves. And where we come into play is sometimes we see families in that 100 to 500 range that start their own single family office, but want to utilize us for whether it's consolidated reporting, access to directs, access to alternatives, and they can do that. But I think that helps at least frame up where that's come from, specifically here in Texas.
Okay, thank you, Matt. So Andy, I know, you came from a place of success with Schwartz and Bro, and have an entrepreneurial background. We don't have time for my favorite Andy's best investment, but sometime if you see Andy at the Sidewalk Cafe, ask him to tell you about the best investment he ever made. But Andy, so what have you, from your perspective, how have you seen family offices evolve in the last few years?
Yeah, I think it has. I think it has evolved. I'll also, if I can tag on just a little bit, as part of a single family office team, one of the things I was thinking about, or it's important to note, is that we provide a range of services that extends beyond just basic investments. There's some strategies for legacy assets that need to be moved from one generation to the next, and a variety of other services that we provide. As far as what our experience has been on family office evolution, I can give you an anecdote. We belong to a forum of a small group of family offices, 10 of us, that include both principals and investment professionals. And what I see from those meetings that we have with those individuals regularly, those friends, is their primary focus is on private equity investments. I will say that it's been a challenging time. I think David commented on that as well, with the valuations where they are. But that seems to be the evolving theme, where people are looking at alternative investments and private equity investments as a way to generate alpha.
Okay, all right. Thank you, Andy. Matt, I want to go back to you for just a half second. You've mentioned, you specifically sort of singled out Texas. And I've heard you speak before that not family offices function differently regionally in some form. Can you just touch on that for a minute?
Yeah, that, as Andy alluded, there's a lot of these pocketed groups that meet and collaborate on opportunities. And I think there's just comfort in that you have a counterpart. And a lot of times it's the family that is a specialist in that particular sector that you can go to. If we decide we want to buy a chocolate factory someday, I'm probably going to call David. His family has expertise in that particular group. But here in Texas, it is a lot different because we do collaborate. I think it's a little more closed off when you look at different geographies such as New York City or even the West Coast and California. And the families that have made wealth here have made it differently too. So you find a lot less venture capital investing here in Dallas, Texas, or hedge fund investing, whereas it's the complete opposite out in Silicon Valley and the West Coast, as well as New York City is a little bit more tight on the asset management side, as well as hedge funds.
Okay. All right. Thanks, Matt. So let me ask this question. I'll go back to Andy for a minute, or I'll start with Andy, and then we'll kind of go through everybody. Andy, how can you speak or elaborate a little bit more on how you're allocating capital currently? How much is managed by professional managers and public equities? How are you allocating the rest? Can you share a little information around that?
Sure, John. So as far as we're a little unusual in that our allocations in public equities are really managed through independent advisors, Merrill, UBS, and a few other firms. In fact, we've gotten good recommendations from Matt and his firm as well. The alternatives that we manage are, I'd say the greater percentage is focused on things that generate current return. And then a smaller portion is in longer duration investments that we're in to generate a high MOIC, higher multiples. So we have 3 different Thompson family members who we counsel and represent, and 2 different generations. And of course, they have different risk tolerance. So each investment recommendation we make to those individuals is really tailored independently, and each potential investment may be suitable for 1 or 2 or all 3 of the individuals.
And so, Andy, to tag onto that, can you speak to how, I think the answer is obvious that there has been a change, but how has it changed from January of, prior years, January forward this year?
Well, we were pretty optimistic that there would be, maybe that's not a good term to use, but anyway, we thought there would be some opportunities that would come out of this sort of sea change in the world with the advent of COVID-19 and the social distancing and everything that's happened. It's been a terrible impact on a number of families, but the evidence was that markets were going to reprice significantly. We were prepared, like we were in 2009, 2010, to invest rather aggressively, but and I can elaborate on that a little more later. I'll let the other guys weigh in. We just haven't seen as many opportunities as we thought we would.
David, how about you and your various investment vehicles? What's changed? What are you doing today?
So going into this environment, we were very liquid and we had a plan in place. So it was all a matter of green lighting what we had built and what we had prepared. So we were very active buyers during the March lows, not only in the stock market, but also in credit markets. Compared to 2008, 2009, the Fed's response and the speed at which they responded, and even the speed at which our elected officials responded, was multiple months faster than it was in 2008, 2009. So the Fed took incredible steps to stabilize markets, especially credit markets. And that also helped stock markets as well. But, we continue to see some distress and dislocations, especially on the credit side. Although the market has been just flooded with liquidity from the Fed, what you're seeing is right now you're still in a holding period on credit markets, where even if there was a default or a missed payment, or you're in this 30, 60, 90-day period where people are trying to figure out what they owe, how much they can pay, and that flows through the whole value chain in credit markets. So using the example of commercial mortgage-backed securities and how that rental income flows through the cycle. If the tenant isn't paying, then the landlord isn't paying the mortgage, then the CMBS is going to default. So right now we're in that holding period where a lot of credit situations, while there might be dislocations, credit spreads have tightened because of the Fed activity, and you're also in this 60, 90-day holding period based on the structure of the securities as well as the docs. So, companies are working all day, all night with their lenders, with their partners, as they should, to figure out how they can get out of this.
Okay. David, it's very interesting that you mentioned credit. We work with a number of clients and was speaking to one of the very large major banks about an upcoming renewal for a client, and ask about making some changes and indeed actually expanding the credit. And I was a little surprised to get the answer back that they had frozen there were literally nobody. They are not expanding credit during this time frame until they see how the virus shakes out. So, even unrelated to real estate, they just flat said, you know what, we'll renew things, but we're not expanding anything at this point in time. Matt, same question for you. What's changed? What have you moved toward? Well,
we've just like both Andy and David, we've had to pivot quite a bit. The majority of our families are very liquid. We went into this with a very conservative approach, and we had a certain amount dedicated towards distress prior to this. And if you look at the capital markets globally, there's always distress somewhere. So we had positioned ourselves for distress. This was just astronomical compared to what we were thinking it was going to actually be in. So we had to pivot. We were actually involved in a Series B investment in a prop tech business that we were going into the final closing of this business alongside some well-known venture capital groups, and we had to punt that down the line because the market's changed. Family offices aren't funding growth stage businesses like that anymore that are losing $40 to $50 million. That have to go back and continually tap the capital markets over and over in order to stay viable. So that play for now is done. So we had to move on that. And then we had committed to a handful of strategies on the private equity, private credit side prior to the down cycle. And one thing about private equity and private credit is it doesn't reprice. So a lot of our managers have been open for about 12 to 18 months raising capital throughout that time period, investing that capital into opportunities. And we tend to go into the final round, the final close when we invest in private equity opportunities. And so one of our distressed credit managers that we had committed to in January that was closing in late March had already deployed 47% of their capital in pre-COVID opportunities. And when you go in at the later stage rounds, you're not repricing those rounds. So you're still subject to paying that same price. So we had to pivot there on a number of opportunities, start fresh. Fortunately, we have a lot of managers that we work with as well as opportunities out there. And we had to start from a clean slate, which is a lot easier then because then you're not having to do the initial analysis on what they bought in pre-COVID and then trying to price that. Right now, you can't get pricing. And John, from what you just alluded to is exactly what we're seeing on our side too, which is everybody's kind of pushing things off because we really don't understand or have good knowledge as to what the earnings will be.
Okay. So let's sort of explore that just a little bit more. So one of the things that I've heard is this distressed theme. So I've had people ask me about, and I'm not an investment advisor. I've had people ask me about, is it time to buy airline stocks? Clearly airline stocks are distressed. I would make the case Warren Buffett sold, so perhaps not. But let's talk. So do you rush into distressed? Is this a good place to be? How do you? Matt, let's start with you, and we'll kind of go around the table again real quickly.
Not a time to rush in at all, but you should have some allocation to it right now. And
right.
What I mean by that is when you're utilizing these managers, they're not going all in day one. They're investing at their discretion over the next 12 to 18 months. So for us, we're using two broad-based themes on how we're attacking distress right now. One, just like David is on the corporate distress side, you've got $3.5 trillion worth of BBB paper right now. And so that's right above the line before they become what's called a fallen angel, going down into high yield territory. And that's where a lot of us are playing right now. Unfortunately, as Andy and David both alluded, that's where the Fed is playing too. And they like to play a little bit above that line, but now we're seeing them drop down into names like Ford and rescue certain businesses there. Now we're going to go ahead and catch a lot of those via some of our relationships. And as family office professionals and multifamily office professionals, we run screens as to who the top players in that space are. And you come out with the KKRs, the Cerberuses, the Bains, Oak Trees, GSOs. So there's a handful of players out there that have done this throughout the past couple cycles. And what you see when you look at vintage level returns out of those past cycles on the corporate credit side is 50% plus IRRs from those groups, from what they're producing. That doesn't necessarily that we're seeing that open up today, because as David just alluded, where credit spreads are, they've compressed here recently, but I'm of the belief and of the mindset that those are going to continue to widen out, and there's going to be ample opportunity to go into it. So back to your question, you've really got to pick your spots right now, and you've got to have a plan in place, because if you're just waiting for the shoe to drop and then go ahead and allocate capital, that's going to be way too late.
Okay. All right. David, any comments around distressed investing? I think you mentioned distressed credit was something you guys were looking at.
Well, I think, generally, I think you can't rush into anything. You absolutely, as Matt said, and if we've done, you have to have a plan in place. But patience is key in any investment. And, we try to simplify a lot of things and use the KISS principle. And, real simply, especially on the credit side, and even using it for real estate or stocks, you can't overpay. Really simple, you cannot overpay for assets. So your long-term multiple, your IRR, it doesn't matter what metric you use, but if you overpay for an asset, that's going to affect your returns over the long term. Generally, as Matt said, and I said, the Fed is playing in credit markets. Credit markets run the world. And I think that the Fed acted appropriately stabilizing credit markets. But I think the problem moving forward is, on the margin, every new additional dollar of government debt is having less of an impact. Mm-hmm. Let's go back to economics and the velocity of money. The velocity of money is slowing down, which will affect GDP growth. So what the Fed is doing is, in my opinion, they're inflating financial assets, particularly stocks. And they're inflating assets like stocks by funding the credit markets. They're entering into buying, lending, and purchasing facilities, buying things that they've never bought before. And since the financial crisis in the past 4 years of quantitative easing, the money supply has just grown so substantially, and it's grown substantially faster relative to the growth in GDP. And that's by definition the slowing down of velocity. The same story can be told about corporate debt. Publicly traded companies, while their multiples might be high, they've also taken on a high debt load. So their earnings multiples are high, but their earnings are compressing. It's not growing year over year when you look at SPY earnings from 18, 19, and you look forward looking today. So the debt loads are getting higher, but credit spreads are tighter. Those trends just can't go on forever.
Okay. So look, I know we're getting, we got off to a little bit of a late start. So we're really move to one last question for the group, because I think this is something important for our participants. So post COVID-19, how are you adjusting your capital structures? Is there a move in purchase price multiples? Which sectors, what kind of debt multiples? So let me start with Matt. We'll go to Andy, and then David, and then we'll open it up for Q&A. So Matt.
It's changed, and it's hard to necessarily price anything right now. And so I think that's why you're seeing a lot of us push these things off. And some strategies that we're going into right now, even on the secondary market. So what that means is we've seen just the proliferation of private equity grow to the extent of 3 times the size that it was in 08, 09. And one of the top strategies, as well as the corporate credit side on the distress side, that performed extremely well during those last two downturns was the secondary side. And so that means buying high quality LP stakes from distressed sellers. And those distressed sellers can be those can be endowments, institutions, or high net worth individuals. And right now you're starting to see a lot of those groups go to the market and try to sell those assets. And we, as the buyers of those assets, are offering something that they're not willing to accept yet. But also, we don't know enough about the underlying holdings yet to necessarily make that bid solidified. But right now, we're circling that. And to provide some examples, back in 08, 09, that market was down to 63 cents on the dollar. And you're buying private equity positions for 63 cents on the dollar. Eventually, those come back. They're 2 years into the maturity of them, so you're at least having a better understanding of what they hold. And you're mitigating part of that J-curve effect as well. But that's a strategy that we're circling right now. We know that it's going to take time before we see that pricing come into play. And I can't tell you a number today because it's unknown.
Okay. All right. Andy?
Yeah, about the most focus we have right now, similar to David and Matt, short duration first lien commercial credit. We've actually began to partner with some, I'd call them our friends and local experts, to do some AR factoring and some specialty finance opportunities. I think those are very opportunistic investments and will likely be relatively short term. I just don't see much else out there that it seems appropriately priced today.
Okay. All right. David?
It's absolutely most important to be senior and secured, both when you're talking about the debt side and the equity side. Even on the private equity side, the rules are changing. I'll use the example of venture capital markets. So really, for the most part, it's been a founder's market, a founders friendly market, raising capital for over 10 years now. And investors are pushing back. In the private equity world, the 2 and 20 model is probably going away. Investors, big limited partners, are asking either for parts of the general partnership or to lower their fees. So again, it's with an event like coronavirus, all that does is accelerate change. The rate of change that's happening right now, all the disruptive things that we thought that they were going to happen in 3, 5, 10, 20 years are all happening right now. And that's the incredible thing. So you can use that and apply that to different, things, everyday things, financial markets, investing, whatever it is. So the rules are changing, so we think about things differently. But we definitely like to be senior and secured on the credit side. And then on the equity side, if we're not buying the right price, we're looking for preferences, for potentially more control over information rights, board rights, and trying to build back that leverage from the investment side.
Okay, guys, thank you very, very much. Now we're sort of at the end here, but what I wanted to ask you to do, we didn't get a chance for any of our participants to ask any questions. Could I ask you to stay with us for another five minutes or so? Simon wanted to put some just some of the audience questions to you. So Simon, I'll hand it off to you.
Okay, so for those of you who have something to leave at 9, we normally try to finish at 9, but if you can stay with us for a few more minutes, I think this first question is going to be very relevant. A lot of the folks online are asking, which is, how do entrepreneurs and organizations in the entrepreneurial ecosystem, like incubators and places like that, how do they contact you and start having a discussion with you? So how do entrepreneurs contact you or incubators, accelerators contact you for building of a relationship?
Great question. I'll jump in here, and I mean, I'm a pretty open book on LinkedIn. You can find me, but for the most part, family offices by definition hold things a little closer to the vest. So, for example, while I'm on this panel right now, we typically or normally don't market ourselves or talk about what we invest in. So I think that that's the careful consideration for entrepreneurs is knowing your audience. So each audience is different. So a family office audience is a little more private in how they invest and how they market compared to a venture capital firm who is in the business of making investments, attracting new companies to invest in, identifying and finding the best founders and partners. And where we found success working with entrepreneurs as well as venture capital firms is, finding good co-investment opportunities through a venture capital relationship. So, I think that it's best for entrepreneurs to talk directly to venture capital firms, because at the end of the day, it's very unlikely that a family office would price, write a term sheet, and close a deal all on their own due to limited resources. Many family offices like to work with some sort of financial sponsor or venture capital firm. But I love talking to entrepreneurs every day. It's the best way to keep the pulse on the frontier, on what's happening locally and globally in the world. For entrepreneurs is that's what the U.S. is made of. Free enterprise, free markets, creating new businesses, creating jobs. That's what it's all about.
I'll add to David's comment. We look at dozens of potential investment opportunities every month, and although we're fairly conservative, don't do pre-revenue, don't do much in venture capital, we have involved ourselves in those through a couple of funds that are doing a terrific job. I'm also available on LinkedIn, and glad to share my email address with the participants if John and the group wants to do that after we get off the call.
Okay.
And can I just echo that real quick? I am on the same page with David and Andy, and we tend to not do anything pre-Series B. And so we like to see that business established. We like to see an adult in the room, in the sense it is that venture capital partner the majority of the time. Oftentimes as entrepreneurs, though, you could find the family office specialist in your given category. So what that means is if you're a tech family, there's probably a family office in Dallas, Texas that made their money in your particular trade, and they might want to talk to you. If anything, maybe you offer them a piece of your business to get on your advisory board, and that accelerates things.
All right, great. I'm looking through some of the questions. How about just your thoughts on what are your thoughts regarding the current and near-term allocations to venture capital? Do you guys have any allocations towards that, or do you plan to? Those sorts of things.
Yeah, I'll jump in here. Thank you for the question. The question is about venture capital allocation. We are a traditional investor into venture capital, so by a percentage or allocation basis, we invest as a limited partner into funds. That being said, we've also invested in directly into companies in various stages. Generally, we think about venture capital as higher risk, higher return, but it's not necessarily a focus when you look at our total asset strategy. But we're always open, and we love crazy ideas and opportunities.
All right. Matt and Andy, do you guys have an allocation for venture capital?
Yes. So I'll go ahead and jump in here. So we have a dedicated effort to the venture capital, mainly as David is, just as LPs. And so we'll commit to 5 to 6 managers this year. In fact, the venture capital world has opened up astronomically. The benchmarks, the Excels, Batteries, Founders, all the name brand groups who wouldn't take your capital before, they're now entertaining those conversations. So we have an active effort right now. We're engaged with the top 10 venture capital groups and able to allocate capital towards them. And then on the direct side, a lot of times, just like David and Andy, we get the benefit of a lot of those co-investments, but a lot of times we're able to wiggle our way in there and provide direct capital alongside those main players. And we should be doing about 4 to 5 of those direct investments this year as well.
Very good. Thank you, Matt.
Yeah, in our case, we don't do any direct investment, venture capital investments. But as I said, we're in a couple of different funds. One that's that are some experts in early stage seed medical technology, where they've already made some great progress, and also in a fund with a very successful local group that does growth stage technology investments on a royalty platform.
All right, and so to be respectful of everybody's time, I'm going to give you one more question, and this is a question that I get a lot from my students and folks at SMU, which is social impact companies. And so, do your offices have any sort of leanings or opinions or thoughts about investing in social impact companies?
I can start with that. A couple that immediately come to mind is we've made an investment in a company that does lighting, heating, and air conditioning retrofits in legacy buildings, and they do it in an innovative way where there's a share of the there's a share of the savings that's generated from those retrofits, and of course that has an ESG component, but it also works very well. We're also investors with a sponsor in a company that markets utility contracts to individuals and small businesses. But the interesting component of it is a portion of the marketing team are inmates who have left the prison system, and we're giving them a leg up to give them the offer of a job when they get out. And we've seen kind of remarkably lower recidivism rates from doing that.
Very good. Thank you, Andy.
For our Ward family office, we fully separate our investment office from our foundation. So our investment office, we specifically focus on investment returns. You know what? We are a generous family. We always have been, but we do that directly through the foundation where we like to make an impact. So we think about investment returns, growing and funding future foundational commitments that flow into local communities, education, healthcare, several priorities that we have and that we have identified on the foundation side. So,
okay, very good. Thank you. How about your folks, Matt?
It's a big focus of ours, and we actually have a dedicated effort to it. In fact, we have a partner that we just hired. It's a bit of a VIP partner arrangement, and she is dedicated solely to ESG efforts for our families across the globe. And she's been doing this for a large family office actually here in Dallas, Texas. And our families ask about it, and we push them towards it. I believe there's a lot greater causes that these families can be allocating their capital to in that effort, and we want to provide a solution for it.
All right, well, wonderful. That's a great way to end today. All right, everybody, we've now concluded our first ever online Southwest Venture Forum. Our current plan is to get back together in analog format on September the 17th. But you know what I think? Once we actually see each other face to face, I don't think we'll know what to do. I think we'll sort of have to hold cameras to each other and kind of talk through that. Panelists, John Cherry, Andy Schwartz, David Ward, Matt Ogle, are 3 entrepreneurs. Thank you so much for doing this. And hey, everybody, be safe. Have a great summer. We'll see you in the fall. Thank you very much, everybody. Bye-bye.
Thank you, guys.
Thank you.